This sell-off, what to expect next from this volatile market. Joining us is Hennion and Walsh Asset Management President and CIO Kevin Mahn and Morgan Stanley Wealth Management Managing Director Dan Skelly. Guys, tell me something. Kevin,
yeah.
What happened? What happened? Give me a diagnosis here. Why the dramatic move today without a ton of news? And does the buying that started just before 3:15 tell you anything?
Yeah, I would start, John, by saying that March Madness is upon us. However, this year it started in the stock market as opposed to on the basketball courts, as investors continue to climb that proverbial wall of worry. Whether it's fears over an economic slowdown, a potential recession, tariffs, overspending on AI, check any box that you like. But this has led into a pullback and increased volatility. But to me, I see encouraging signs, particularly as it relates to market leadership. If you pull out consumer discretionary and information technology, the market's actually doing quite well year to date. I'm also seeing value outperform growth, international outperform U.S. markets. And to me, that's a reminder of the benefits of diversification. Don't overweight your portfolios in just 7 large cap technology stock. Look into other areas of the market to give you downside protection, but also allow you to take advantage of these changes in market leadership that we see developing.
Okay, maybe a little, salve, balm for the disciplined. Dan, a lot of people gave cheerful 2025 S&P targets, but said there's going to be volatility in the first half. Well, here it is, right? Anything to change your target or assessment of the market versus weeks ago?
No, John, for us, the key takeaway is something we emphasized with you on this program back in January, which is that the market consensus in January around American exceptionalism had come a bit late. American exceptionalism has been an unstoppable force for many years, but it's run up against the immovable object of high valuation, policy uncertainty, and finally starting to see some catalysts outside of the U.S. So for us, the base case for a soft landing is still intact. We had always favored a broader market and more differentiated leadership in 25 than 24 and 23, and we're sticking to many of those key themes.
So, Kevin, what about sentiment?
Yes.
This is an expensive market by historical standards. Does a move like this shift the way maybe retail investors in particular feel about the market, and how long does it take for those feelings, right, for the cry to come out?
It certainly does. Coming off of 2 consecutive years of 25% plus performance, investors weren't braced for this type of volatility. They were expecting yet another double-digit year in terms of performance of the stock market this year, and that may not be realistic. But that doesn't mean you abandon the stock market together or abandon your longer-term financial goals and objectives. Rather, stay true to your risk tolerance. Stay invested in the markets. Give yourself some degree of downside protection, but don't try and time the market. We all know that's an exercise in futility. In fact, my biggest question right now, John, does the Fed come to the rescue if, in fact, the economic slowdown does intensify? Of course, they're caught right now between a rock and a hard place. High levels of inflation, and we'll learn more about this week, and a slowing economy. I think they cut rates 3 times this year by a total of 25 basis points, but we'll learn more next week.
I mean, rock in a hard place, Dan, or Scylla and Charybdis. You've got the increasingly tough nut of higher interest rates, and you've got the questions about what these tariffs are going to really mean in the longer term. I mean, Canada doesn't seem to be bowing down as somebody might have hoped, and maybe the prospect of a protracted trade war is weighing on this market, no?
Absolutely. And look, the market has correctly started to shift lower, and many Wall Street firms, including our own, are marking down some growth estimates. But let's keep in mind, John, that we are kind of myopically focused on the moment at all of the painful policy medicine that we're getting at the moment, but we still have policy candy yet to come later this year in the form of tax reform and potential benefits from deregulation. So we would agree with many of Kevin's points. We would be selectively adding today in terms of finding attractively valued financials, industrials, powering AI and AI infrastructure, selective ideas that could actually benefit if this market finds some stable footing towards the middle and end of this year.
Okay, Oracle results are out. We are going through them. We'll bring them to you as soon as we get them. Kevin, is there an increased importance, perhaps, in these Oracle results and guidance and Adobe this week, given that tech has been such a big part of the volatility, and these are two pretty sizable names reporting off the cycle of the other sizable names.
Yes, but isn't technology always important in the mindsets of investors who generally hold tech more than any other sector? What I'm encouraged by with Oracle, though, is that $100 billion Stargate initiative that they have around infrastructure with OpenAI. I like the stock because it pays an attractive dividend yield above 1%, and it's trading at a reasonable multiple, around 22 times forward-looking earnings. That seems like a good place right now. I believe earnings per share estimates are around $1.48. If they come in slightly above that and provide positive forward-looking guidance, that could be good for the stock. On the other hand, if it's contrary to that, you could see another reason for tech to correct a little bit further.